In this last segment of the chapter, we're going to be talking about bank runs and how that affects money supply, and also talk about the federal funds rate. Now, a run on the bank is a really bad thing. We probably haven't witnessed it in real life, but we may have seen a depiction of it in movies such as Mary Poppins or It's a Wonderful Life. Now, a bank run typically occurs when the public or the depositors fear that a bank might become insolvent or have some kind of financial difficulties in the future. And so the idea is that people would run to the bank and ask to withdraw their deposits. Now, the United States hasn't seen a major bank run in recent years, but in the UK, or United Kingdom, there was a bank called the Northern Rock Bank that experienced a bank run in 2007, and as a result was eventually taken over by the government. Now, bank runs are a problem for the entire regulation of money supply. So if you think about banks being the creator of money, or banks being able to create money, if everyone came to the bank at the same time and asked to withdraw their deposits, then the bank is not going to be able to satisfy the withdrawal request from all its depositors, and the bank could become insolvent because it doesn't have enough cash to hand out to everyone. Now, when a run occurs, the bank is typically forced to close its doors until some bank loans are repaid, or some other lender, such as the central bank, would provide it with the solvency it needs to satisfy the depositors. So bank runs really make life very complicated when it comes to controlling the money supply. During the Great Depression in the 1930s, after many banks had closed and there were some runs on the banks, households and bankers became more cautious, and households withdrew their deposits from banks, preferring to hold their money in the form of currency. So this sort of a practice reversed the process of money creation, and bankers responded to falling reserves by reducing bank loans, right? So if all this money is going towards these people, right, it's flowing outside of the banking sector or the banking industry, then banks make fewer loans, and therefore money supply would drop. So in the 1930s, or during the period of the Great Depression from 1929 to 1933, money supply actually fell by 28%. And this really can make the system contract a lot and lead to a more severe recession, because there is a lack of liquidity in the system. People are not going to have money to spend. Businesses are not going to be having all this money to invest in businesses. And so this has been a bad thing. Now, today, bank runs are not such a major problem for the US banking system or the Federal Reserve. The reason is that the federal government now guarantees the safety of deposits at most banks, primarily through what we call the Federal Deposit Insurance Corporation. Depositors do not make runs on their banks because they're pretty confident that if the bank would become insolvent or go bankrupt, then the FDIC will make good on their deposits. Now, this is not true for any amount. This is limited, I believe, up to $250,000 in your bank account is secure and insured. So anything beyond that isn't. And at that point, I think you can create another account with another bank, and then that money will again be insured. So the policy of the government deposit insurance has some costs or some disadvantages. Bankers whose deposits are guaranteed sometimes have very little incentive to avoid bad loans or avoid, just lending to riskier borrowers. And so when that happens, of course, there is a disadvantage, because if the loans are not repaid, then again there's a liquidity crisis, and someone has to bail out someone else because of these bad decisions. But the benefit of deposit insurance is that it creates a more stable banking system, and as a result, more people see most people would see bank runs only in the movies. The next thing we're going to talk about is the federal funds rate, and this is something that is talked about a lot in the news, and this is a very important interest rate that governs how other interest rates move in the short run and the long run. So think about a scenario where Bank of America needed some funds. So this is just in a particular day. Bank of America borrows from Citibank. Let's say it needed $30,000. Okay, so Bank of America borrowed this money from Citibank. Now, Citibank is going to lend $30,000, but obviously Citibank is going to charge Bank of America an overnight interest rate, because this is just something that Bank of America wants to borrow for a day, and then it promises to repay Citibank the next day. So there's going to be an overnight interest rate, and that interest rate is called the federal funds rate. So the idea here is that banks that have insufficient reserves can always borrow from banks that have excess reserves. So in this example, perhaps Citibank has some excess reserves, and Bank of America has insufficient reserves. And so this transaction would take place. Typically, the Federal Open Market Committee of the Federal Reserve uses open market operations to target the federal funds rate. Okay, so it is the FOMC that uses open market operations to target the federal funds rate. And again, this is in an attempt to control money supply. Now, changes in the federal funds rate cause changes in other types of interest rates, like what you would pay on loans, what you would pay on your mortgage, and things like that. So it really has a big effect on the economy. We can illustrate the relationship between monetary policy and the federal funds rate by using a graph. So in this graph, what we have are quantity of federal funds on the x-axis. So this is quantity of federal funds. So this is, these are the funds that would be available if Bank of America wanted to borrow from Citibank, right? And so you can think about other banks participating in this market. And so there's a demand for these funds, right? Demand was from Bank of America, and the supply of funds is from Citibank, for instance. Okay, and so on the y-axis, we are measuring the price of these federal funds, which we call the federal funds rate. So this is really, we're in the federal funds market, and this is the Fed funds rate, R. Okay, so now this is the interest rate, the intersection between supply and demand is giving us the federal funds rate that, or the federal funds rate R star that clear the market, and F star is the quantity of federal funds that would clear the market, where supply would equal demand. Now, the federal funds, so the Federal Reserve Bank can actually influence this rate by doing open market operations. So typically, what the Fed funds does is it influences, what the central bank does is it influences the supply or the quantity of money, right? So the Fed always would try to change the supply depending on what it wants to do. So if the goal is to create more money in the system, the Fed would conduct open market purchases, right? So they would buy treasury bonds from banks and inject money into the system. When they do that, money supply goes up, and that would be reflected in a downward shift of this supply curve. A downward shift of the supply curve, which is telling us that there are more funds available now. So the new intersection between the old demand curve and the new supply curve is here at F1, at which we are at a lower interest rate than before. Okay, so anytime the Fed wants to create more liquidity in the system or have more reserves in the banking system, it can do so by doing an open market operation, specifically an open market purchase, and reduce the interest rate. So R goes down, and this would stimulate the economy, right? So this fall, the fall in interest rates stimulates the economy because borrowing is cheaper, so firms and businesses would find it more inexpensive to borrow from banks because a lot of the interest rates are just tied to the federal funds rate. The federal funds rate is very significant because very many different types of interest rates are tied to this. So your mortgage rate or the prime lending rate of the banks, everything moves in accordance with the federal funds rate. And so we can take a look at what this looks like by typing in federal funds rate. And so you can see what's going on with the federal funds rate over time here. And now only recently the central bank, our Federal Reserve, because of the COVID-19 pandemic, has acted and tried to create more liquidity in the system by slashing interest rates. So going back to the diagram, it has really brought interest rates by increasing supply. It has brought the interest rates closer to zero. Okay, and this is going to be associated with a higher quantity of federal funds in the system.